It's crazy. So let's jump right in and see what's happening in the markets and kind of what we can do to be prepared for what is to come. So let's just start out with what is going on with the markets. Everyone saw in the news what's happening with banks. To make it really simple, well, it's not a simple process. It's not a simple problem either, but people are afraid. They're afraid of, is their money safe, right? As you know, FDIC insures up to $250,000 per person per account. So if you have two people on an account at Wells Fargo, you have up to $500,000 federally insured. But what's scary is what Yellen just said the other day. She basically said that the smaller banks aren't as important as the bigger banks. So if you bank with a community bank and you've got a lot of money in there, you may have the position where that bank may not have the liquidity to cover any losses if there are any. And the losses are coming from banks investing in really low yielding bonds over the last couple of years. And now those rates are significantly higher. So what they're holding is worth less. So if they need capital, they have to sell something that's worth less than what is the actual market value. And that is causing a liquidity crisis. So that's why there's an infusion of money into these banks. And it's kind of crazy. We saw today some Swiss banks coming together, merging, which hasn't happened in banks of that size since 2008. So that's really interesting. What is scary about what Yellen said is they're going to back and insure the banks that are too big to fail. And she has her own little litmus test on what that means based on who she thinks is the bank that could really bolster our economy and keep it going. So the smaller banks really aren't very irrelevant to them, or are irrelevant to them in the scheme of things, which is kind of scary. Because what does that mean? That means if somebody is banking with a small bank, they'd be more apt to say, well, why would I bank here if I'm not insured? When Yellen just said she's going to back the big banks and guarantee the money regardless of the national mandate of the FDIC $250K per person. So common sense would say, okay, I'm going to take my money, put it in with the big banks if they're too big to fail, right? That's what the fear is right now in the markets. So the bond market is all over the place because of that. Now, one of the weird things, sorry about that. One of the weird things about the bailout, if you want to call it that, basically what Yellen did and what they did is they took 11 banks, the capital from them, and they all infused a portion of that into the banks that needed it. So what's bizarre is it's like, imagine calling Walmart, Costco, Target, and Amazon and encouraging them to buy a bunch of stuff from another retailer that's having a tough time. Like that's exactly the equivalent of what's happening. These other banks are basically giving liquidity to the banks that are failing to prop them up. It's kind of wild. Haven't ever seen anything like this before, so we're going to really keep close tabs on what's happening. But the sad thing is those banks that are doing that, they're not just going to do that out of the goodness of their hearts. Guess where the costs of doing that goes to? It goes to the consumer. So nothing in life is free. You can't just give money away and expect that bank to be okay with giving their money away. There's a cost to it, right? So when we're just going to really keep a good eye on what's happening there. It's very interesting. So diversifying right now your money into banks so that you are in a position of security of that $250 per person is important. So you do have any customers that have all their eggs in one basket, it may be a time to really reevaluate that. So let's talk about inflation. Inflation is the biggest enemy of mortgage rates. So the consumer price index, it actually rose 0.4% in February. So that actually has a declining CPI from 6.4 to 6.0. That's really good news for mortgage bonds. And we'll get into what that did to our markets in just a little bit. The core CPI, which is the Fed's favorite one, it pulls out energy prices and food, and that actually increased 0.5%, and that went from a 5.6 to 5.5. So not as huge of a drop, but it's still a drop in the overall core CPI. So the bottom line is inflation is not dropping as fast as we would like it to because the shelter index, and I'll go over that in a second, the cost of shelter, the average is actually going up. It's 8.1% year over year, which accounted for 60% of the total increase of the CPI. So that's a huge cost. And in real time, shelter costs are actually coming down, which should lead to lower inflation, which should lead to better interest rates. So let's have a look at the shelter costs. If you see right here in 2021, shelter costs, and these are apartment rents, rentals of homes, actual shelter costs, they went on kind of a roller coaster ride. They went way up. I don't know if you guys remember writing leases and you had to go way above asking for renting for apartments. They were really high. And they've come down and now they're really low comparatively to where they were. But keep in mind, if you did a lease 10 months ago, that was really high. That number's still on the 12-month average. So it's like that roller coaster, right? The average is actually going up because we're still averaging these that are increasing on this part of the roller coaster. We're averaging these increases into the 12-month average right here. So that's causing our CPI to go up on shelter costs, even though in reality, the daily is way down here. So that's the problem when you have an average that is given as the leading indicator for inflation. It's like driving while you're only looking in the rearview mirror. Like that's not how the economy should work. But that's how all of these CPI, all these inflation numbers, that's how they're presented as a 12-month average. So they're skewed right now in a big way. So what does this mean for the future? It means we should see the overall inflation numbers drastically come down. And keep in mind, the Fed wants to hit 2.2% as the inflation rate. Right now, we're in the 5s and 6s, or 4s and 5s and 6s, depending on how you look at things, for the different indexes. So this should get a lot better. And this is one of the reasons why inflation is stubborn right now. So we did have cooler than expected inflation on the producer price index, which was another good news. So we saw it from January, the year-over-year basis went from 5.7 to a 4.6, which is great. And so we are seeing the impacts of the PPI and the core PPI come down. So again, lower inflation means really good interest rates. Okay, so keep that in mind as we move forward. So this is kind of what's happening right now, the impact of further Fed rate hikes. The Fed is going to be doing a very, very important meeting this week. They are going to be announcing what they are going to be doing as far as the next Fed rate hike. Literally 2 weeks ago, everyone was expecting 50 basis points. And then we saw what happened with the banks, and then they're like, whoa, let's maybe think about a quarter. Now they're contemplating a pause and not doing anything. Now, there's school of thought on what they're going to do. This is just what the rumors are flying. Nobody knows. If they go in 50 basis points like the European Central Bank did last week, it's going to cause major turmoil. And you're seeing that with some of the banks that are over there right now. So we think it's going to be a quarter. I don't think it's going to be paused, but we'll keep our eyes on that. Remember, the margins on their money and what they're holding on their bonds, as those go up, the money they're holding is worth less. So as they try to get liquidity, they're losing money. And that's the issue that we have right now. There was a terrible stress test regulation that was put into place. And in those regulations, the stress test for the banks as far as their rate increases was never adjusted to follow what the Feds were going to be doing with raising the rates and doing the rate hikes. So they were all running their numbers and their algorithms for the number of liquidity, the amount of liquidity they need based on a 0.75 increase in the Fed funds rate, and that's it. Well, we've seen a significantly higher boost from that. So let's see what's going on with mortgage rates and the bond markets right now. This is the Fannie Mae 30-year fixed, okay? These are the 30-year bonds, the universal mortgage-backed securities that are traded for Fannie Mae, Freddie Mac loans. If you could see down here, this is where we hit a little bit of a rough patch. Rates are in the 7s here. And then this is kind of when the debacles started. This is when we saw inflation numbers get a little bit better. And we saw quite the ride higher here. So as you can see, though, this ceiling right here at the 101 level, this Fibonacci level, is a hard stop. We went up to it and bounced all the way down here. I mean, it was a ricochet, right? We hit it and we bounced down. We hit it, we bounced down. We hit it again and we bounced down. We hit it again, we bounced down today. So this is a really sticky point right now. If we can break through this, we're going to continue to see rates improve, but we're going to see what's happening with the 10-year. Notice we've seen a 200 basis point swing here. That's a pretty good swing, guys. That's why you saw rates drop so dramatically this last couple weeks, last week and a half. It's been a good ride. So let's look at the 10-year real fast. The 10-year has had even bigger a ride. Let's move me out of the way here. So we have a significant drop here for the 10-year. It's massive. I mean, these are massive, massive moves. We were at above 4 and now we're in the levels of the low 3s. And we do see a very clear bottom right here. So if we can break down through there and stay, we're going to see that will help mortgage-backed securities rise, which means mortgage rates drop. So exciting news on what's happened the last couple of weeks. Despite really what's happening in the overall markets, this is good news for mortgage rates. One of the biggest problems we're going to see, though, is the Feds have been trying to sell off their balance sheet, which is basically all of the mortgages over the past 3 years that they've been buying to bring mortgage rates down. They've been signing those off or selling those off and letting them fall off their balance sheet at about $90 billion a month. Well, they've increased it by $300 billion during this debacle with the banks. So it's a little bit of a head scratcher as far as what they're going to be able to do, because all of those bonds that they hold are in the 2 to 3% range. And again, they're worth less than bonds now. So it's just interesting to watch how that tug of war is going to have its impact on mortgage rates. Bear with me one here. So here's where rates are at. So this is good news compared to where they were a couple weeks ago. National average right around the mid 6s. 15, you're in the 5s. 30-year, you're in the low 6s. And ARMs, as you can see, they're very similar to a 30-year fixed. And then we've got FHA. FHA is always a little bit better than conventional, and as is VA. So this is kind of a snapshot of where we are right now. And guys, the markets they're hopping. I mean, there is movement. So let's look at real estate right now, get a quick update on what the numbers are showing for February, which is the month previous to where we're at now. Here's the housing index. Housing index has actually gone up. So that's really good news. If you look at the single family homes, they are in high demand. So this is more of a builder confidence report. Builder confidence has gone up. We all know that December was kind of a quiet ghost town, right? So we're seeing an increase on that, which is really, really good sign. There is a disparity between supply and demand still, which always has a tendency to support prices. And we are currently an opposite of what we are in 2008 when it comes to the housing bubble. Back then, demand was really low and the supply was really high. Now we have high demand and low supply. You might not think it's high demand right now, but guys, the numbers are still strong for sales. So that's a really good sign. Current sales conditions rose 2 points to 49. So that's good. Buyer traffic was up 3 points. It's the strongest traffic of buyers since last September. So things are looking good as far as real estate continuing to keep and moving upward. Sales expectations are going to tick down a little bit. It always does over the summer months. But what the bottom line is, overall builder confidence is up, and that is a very good sign. So I find this a very interesting graph. This shows the active listing count. To put this into perspective, this line right here is 2020. So these are 2020, 2019, 2018, 2017, and then we have the pandemic lows of inventory right here. And look where we are. We're still at very low inventory, and it's actually coming down a little bit. Now, this is national, so keep that in mind. But look if you were to say that the market was a lot different compared to the beginning of 2020, you could say yes, because the amount of inventory was significantly higher in 2020. We're still very low, and that's going to continue to keep real estate values strong. Here's some interesting stats. This is some perspective for year-over-year increases in property value. Look at Phoenix, 12-month average, we're up 5%. Now, that's an average. Like I said, that's kind of like looking in the rearview mirror. It could have been up to 12 and come down to 5, but still year-over-year, we're positive. That's a good sign. Look at these markets. Now, there's some markets that are negative. I mean, look at Florida. They went crazy down in Miami. Everyone wants to be in the beaches, I guess. But this is good news. This is really good news for real estate. If you're holding real estate now, if you're buying it right now, it's going to be kind of flat or a little negative for a little bit, but the future looks bright. So here's some residential construction numbers. Permits are down 17.9% year over year. What does that mean? That means less inventory in the future. That means potential for continued low inventory. Housing starts, they're down 18% year over year. Again, this means fewer homes on the market, which means if you have real estate, the value should hold strong. Completions was up pretty good, 12.8. So the homes that are being finished right now is pretty high. So that's okay sign. But these two, permits and starts, are kind of like the wow. What's going to happen with inventory in the future? Will we continue to have lower than normal inventory? And the answer is that if it continues like this, absolutely yes. We need more homes to be started for the future homes to be sold. So here's the forecast nationally. Month over month, we are down a little bit. We all see that. We all see we're making a little bit low balls on offers. We're asking the sellers for concessions. But currently, year over year, we're still nationally at 6.9. This is from CoreLogic. And the forecast is month over month. The next month, we're going to have a little lower, but year over year, it's going to still be positive. So good information to share with your borrowers if they're thinking about waiting. Who knows? But right now, the forecast is showing at least positive year over year. So these are home prices year over year. Idaho is the only state to post annual declines in home prices, but we see some pretty good positive numbers here across the United States. So this is really, really interesting. If somebody's saying they don't like to invest in real estate, these are the average appreciation over the years. So if you were a betting person and you have your eye on a team and all of the green is a win and the red are their losses, would you determine by looking at this that you've got a champ on your hands? I mean, you've got one of the best teams in the world. Yes, and that's what real estate is. If you bet against real estate, you're betting against the champ. Because look at this. There's only 5 years here of negative on this side. And back in the 90s, a small one here. We all know what happened in 2007, 2008. We all know the reasons why this dropped. We had massive amounts of homes being built with very little demand. We have the opposite right now. We also had a massive amount of terrible mortgages that were being done for people that couldn't afford them. And they were buying multiple homes with zero down. And then when they had to make the payments, well, they couldn't because they didn't really have the money that they said they did on the applications. So we saw a massive amount of homes for sale because they couldn't afford them. Excuse me. So when you look at this, I would bet on housing all day long. Absolutely all day long. So here's what to look at this week. We've got Mr. Powell, good old Powell. I think the Feds have completely, well, I think they've been terrible this last couple years at managing this. It's been bad, but we're going to see him, Mr. Powell. It begins Tuesday with the monetary policy statement, and then we're going to have a press conference on Wednesday. A lot of times what they say in the press conference is a lot more revealing than their blanket pre-written testimony that they do on Tuesday. So if you look at the last like 20 testimonies, they're all almost identical. They say exactly the same thing. It's just parroting the same stuff over and over. But housing will be in the spotlight with existing home sales and new home sales released. It's Tuesday and Thursday. The latest jobless claims, that's going to continue. You're going to see unemployment rise. That should help with inventory because if people lose jobs, they may have to sell, or moving around the country, whatever it may be. And then the technical picture as far as mortgage bonds, we had a really great week, but we're battling that Fibonacci level, and we're going to really see what happens as we move forward. It's going to be a very interesting week with the Feds talking to see what the markets do, to see what the banking industry is doing. Usually bad news in the markets is good for mortgage rates, but nobody wants bad news of this kind of a nature with the banks. But we're going to really see how this impacts the big banks. If you do have customers that are looking to do loans with big banks, with all the banking issues, I highly recommend trying to avoid banks in this market, but that's just my opinion. That's the technical picture. So bear with 1 second here. So exciting news. If you go to, and this is live, if you go to monthlyhomebuyerwebinar.com, your customers can now register for our monthly home buying webinars. So this is open to anybody. You can have a first-time home buyer on here. You can have any buyer that just wants more information on what's happening with the markets, the different loan programs that are available, how to boost your credit scores, how to prepare for buying, how much you can afford, what rent versus buy looks like, so with some different comparisons. This is going to be an open invitation for anyone. If you go to this website, it's going to ask for the borrower's information, for their number, their email address, and then who referred them, and if they're working with the realtor, and what that realtor's name is, so that we can keep track of your customers when they're going to these webinars. So the first one is this April 7th. It's going to be at noon. Again, it's a live webinar. I'm going to be advertising this on social media. You can send this out to your customers. You can send this out to your database. If anyone's interested in what's happening with the market in real estate, and you want to know what the home buying world looks like right now and some different tips, this would be great for them. So again, I'm going to be keeping track of all of these people that are on these webinars. It's open to up to 500 people. So as far as capacity, we have a huge capacity for this. And then hopefully we'll be able to gather some good buyers for the months to come. So really excited about this. And I hope you guys are too, because it's a great way to at least touch our database and let them know that there's some really good data out there to at least go on and listen to. And this will be recorded, so we can send that out afterwards as well. And don't forget that if you do buy a home right now and you buy it with, the home is purchased with us and we do the mortgage, rates will drop in the future. We know this because we see the trends, we see what's happening with inflation. Will it be in a straight line? No, it's going to be kind of bouncing around, kind of like a heartbeat on a monitor, kind of up, down, up, down, up, down, with the trend going lower. But if you buy now, you can refinance later with no lender fees. So there's no timeline on this. So whether it's 6 months or 2 years from now, it's completely wide open. So I'm excited for the craziness that's in store. So I'll keep you guys updated as we move forward with what's happening in the markets. Obviously, every Monday, we'll keep you guys informed on what's going on. But it's going to be a really interesting ride, and I'm really hoping that these mortgage rates can drop quickly. But we'll see what overall happens. So, any questions with what's going on with the markets currently? Don't be shy. If you are shy, then you can ask afterwards, or give me a quick text or a call. But any questions on what's happening with the banks, interest rates, any questions on any customers, any weird scenarios you have, let me know. I'm happy to help you. I'll stay on a little bit longer. And if you guys have any questions, feel free to ask them. And if not, then have a wonderful week. And let's keep our fingers crossed that the banking situation gets mended, and that we can have a clear, smooth, nice drop in interest rates for the future here. All right, guys, have a wonderful week, guys.
Thank you, Sean.
You're very welcome. Have a great week.
Thank you, Sean. I'll talk to you in a little while.
You got to look forward to it.
All right, bye-bye.
All right, bye. All right, guys, I'm gonna go ahead and end today's mortgage update and enjoy your week, and we'll talk soon.